This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow the podcast on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 31. When you get a chance, if you like what you hear, it would be awesome if you rate and review the podcast on iTunes. It really does help and would love the feedback. For this episode of the Planet MicroCap Podcast, I spoke with Chris Irons, founder of Quoth Research and equity analyst and senior business writer at GeoInvesting.com. I was introduced to Chris via Maj Soueidan from GeoInvesting.com and my guest for episode 14. I wanted to discuss an investing style that, depending on who you talk to, has both positive and negative connotations. For those who don't know, short selling a stock short, or having a short position in a stock, according to Investopedia, is defined as, and I quote, the sale of a security that is not owned by the seller or that the seller has borrowed. Short selling is motivated by the belief that a security's price will decline, enabling it to be bought back at a lower price to make a profit, end quote. There's a lot more nuance to short selling, as will be evidenced in my interview. The goal for this episode is to clearly define and understand what short selling is, how one can do it, why some investors sell stocks short, and how this applies to microcap stocks. Thank you again for tuning in to episode 31 of the Planet MicroCap Podcast. Please enjoy my interview with Chris Irons, but first, a word from our sponsor.
Are you a microcap investor? Would you like to meet with management? If you're a loyal listener to the Planet MicroCap Podcast, you know the importance of qualitative due diligence. The producers of this podcast invite you to attend the Planet MicroCap Showcase, a microcap investor conference on April 26th through April 28th at Planet Hollywood Resort and Casino in Las Vegas. The Planet MicroCap Showcase is 2.5 days of company presentations, networking opportunities, and private one-on-one meetings with company management of undiscovered and well-known microcap companies. So join us at the Planet MicroCap Showcase, April 26th through April 28th at the Planet Hollywood Resort and Casino in Las Vegas to network with like-minded microcap investors and find new opportunities. For more information, go to www.planetmicrocapshowcase.com and register now to reserve your spot. Look forward to seeing you all there.
For this episode of the Planet MicroCap Podcast, I have Chris Irons on the program. Chris Irons is the founder of Quoth Research and equity analyst and senior business writer at GeoInvesting.com. Chris, welcome to the Planet MicroCap Podcast.
Hey, it's nice to be with you. Thanks for having me.
It's great to have you. So, to start off this interview, as I do with each one, what is your background and how did you get into microcap investing?
Well, actually, it's a funny story. I've kind of been investing in the markets since I was 18 years old, and I've spent basically, the first 10 years learning to invest by losing money. I lost money trading equities, I lost money trading options, I lost money trading futures, I lost money trading Forex, and so it was kind of a trial by fire, which is cool because, in the end here, it's kind of my foundation of information on the markets and knowledge on the markets has really kind of been a ground up kind of foundation as opposed to, going to Harvard and taking a bunch of accounting courses and learning how to do it just kind of cash flow and then just kind of punting out the same stuff that everybody else on the street is punting out. So I'm, obviously wasn't grateful while it was happening, but looking back now, I'm grateful that that's the way that I've learned. My experience really is I started to invest when I was 18. I did so for a while without a lot of success. In the process, I learned, a lot of valuable lessons. I went through college. I went through a couple different graduate school programs. And I went and I was working investor relations for a company up in Buffalo for a couple of years and helped them implement their first internal investor relations really function, from the ground up. They had been using an outside firm, and so I kind of helped them bring everything in-house and learned how to work with, securities lawyers and C-level executives to help put together filings and investor roadshows and all of the things that an investor relations professional does. Help them close on some capital a few times. And really from there started to write a little bit on my own in 2011 and 2012. And I've been writing on my own for about 4.5 years. Over the last 2.5 years, I've been working with GeoInvesting, and I know that you've talked to Maj from Geo as well. And Geo is focused primarily on microcaps. We focus on microcaps and we focus on China. So that kind of pushed me in the direction of microcap stocks, but I had a fair amount of experience with it going in and just learning from, like I said, the company that I had been working for prior. And that's really it. Over the last 4 to 5 years has really been kind of what I've considered the time that I've developed majority of my understanding of the capital markets and, equity valuation and all the things that come with being a successful investor. I've really kind of, it's kind of been the renaissance period for me over the last 4 or 5 years. And I've been really grateful because not only have, guys like Maj helped me out a fair amount in learning, but I have a great, following on Twitter, and I've met some people along the way that have been fantastic to me and have helped me learn a significant amount. And, like I was saying, I'm very grateful that today I consider myself to kind of be educated, not on the streets, but really, through the school of hard knocks on the markets versus somebody that is kind of working on the sell side and producing the same discounted cash flow analysis of a mega cap as the guy at the bank next door to him, because they both want investment banking business from the company. So I'm a little bit more of a skeptic. Like I said, I've been on the inside looking out of these companies, so I understand why omissions and redactions and additions and filings happen. I know what little details to look for. And unfortunately, I've had a fair amount of neurosis in my life as well. I have pretty terrible anxiety, which is horrible, but at the same time, when you're trying to deduce large amounts of information and analyze them very quickly without looking at fluff and just trying to focus on facts and evidence, it's something that has really helped me out. And so in addition to microcap investing, where there is some of that, what we call information arbitrage, I also like to look a lot at special situation investing, whether it's, really any kind of special situation. If there's an activist investor involved, if, somebody comes out and issues a very negative or very positive report on a company, I like to kind of go in and try and cut up the facts as quickly as possible and find out where the market may have mispriced an equity, whether it's, to the upside or to the downside, accordingly. So I like that type of volatility. And in microcap investing, I like the fact that, there's a fair amount of information that is public on microcaps that the rest of the street doesn't have access to or does not want to have access to. And this comes, whether it's from companies that go out and file their 10Q before they put out a press release, or management that is accessible and can give you a little bit more color on publicly available information. These types of things you don't really have access to if you're going out and you're taking a stake in Apple. You can't get the CEO on the phone. The algorithms and the sell side are going to pick up on the filings 100 times faster than you'll be able to. And so microcaps, there's this nice, very much like special situations, there's a nice little convergence and divergence that is created from, what the actual truth is, what the facts are, and what the market's kind of narrative or understanding of those facts are. And it's just trying to kind of fill in those little convergence and divergence pockets where we look for a lot of the opportunity that we invest in. So I know that was kind of a long-winded response, but
no, that was short, man. What are you talking about?
I apologize.
No, that was short. What are you talking about? So, anyways, and today I thought would be the topic that I'd like to talk about. That I think, well, what's interesting is when I talked about information arbitrage with Maj, is that it can both help and hurt you, or help and hurt the company, in the sense that, if they purposely omit something that could potentially be negative that you see in the filings, you know what to do, or potentially know what to do.
Right.
And, I asked them, on both sides of the coin what that means, but I thought I would like to drill down more so on the topic of short selling, because that's something that in microcaps, that's something that I have not covered. And quite frankly, I wish I knew more about. So for my audience that may not know, a basic definition of it, what does short selling mean?
So when you get short, so there's kind of two different ways to define it. One is, when you're positioned short, it just means that you are looking to benefit from a stock moving lower. So the price of an equity moves lower and you'll benefit, versus being a long investor, which is, traditional investing that most people do, where you're looking for the price of an equity to rise and to realize gains from the appreciation of the equity. And so when you position yourself short, you're making hopefully an educated that the price of an equity is going to move lower for one reason or another. And there's a couple different ways to do that. A lot of microcaps are listed on the over-the-counter markets, so there's no real options available on those stocks. But, ones that are listed on the NASDAQ or maybe on the Amex, smaller companies with market caps, microcaps, obviously, in the, tens of millions, there's sometimes options offered. So you can go in and you can, write calls, or you can go long puts, or, there's a million different ways to position yourself short doing that. Or you can actually go out and sell the stock short. And what that means is, instead of going out and buying 1,000 shares of a stock and hoping that it moves up and then selling it for more than you paid for it, what you're doing is you're selling the stock first, and then you're hoping to repurchase it at a later date at a lower price, and you're going to pocket the difference between the two. So you're essentially doing the same thing betting on the way down than you would be on the way up. It's a little bit different because you're not actually taking ownership of shares and holding on to them like you would be when you go long. What you're doing is you are borrowing the stock from a brokerage, or directly from somebody that has it, or in the case where maybe you participate in a financing with the company, you have the stock and it's restricted. But one way or another, you're borrowing the stock and you're paying a generally very small bit of interest to the person that you borrow it from, in hopes that you can go out, sell it, and then repurchase those shares at a lower price, at which point they then go back to the person that you borrowed them from. So the person that lends out their shares makes a tiny bit of interest that the person that wishes to borrow and sell the shares pays for. And then hopefully, like I said, if everything goes as you plan, you'll be returning those shares at some point. It will just have cost you less to repurchase them than it did when you originally sold them.
Mm-hmm. So, how would like a lay investor, like me and you, we're just individual investors, how would we go and sell a stock short, or position ourselves short in a stock?
Well, like I said, there's an infinite number of ways to do it. I mean, not actually infinite, but depending on whatever financial assets you want to use, there's arguably a bunch of different ways to do it. So if you're talking about a company like Apple that is, extraordinarily liquid and enormous, you can do anything. You can go out and you can, go long put options. You can go out and go short call options. You can put on.
Chris, you know what? I guess what I meant was, like, I have a TD Ameritrade account. I have can I just do it through that, or how does you actually go and do it?
Well, yeah, that's what I'm. So there's a couple ways to do it. Like I was saying, you can either position yourself short through options. Mm-hmm. You can position yourself short by actually going out and selling the stock short through your brokerage. Instead of just buying the stock, you would just choose the option to sell short and go that route. Mm-hmm. And then again, there's a million other ways to do it. If it's a very liquid company with all different types of financial instruments available, you can go out and you can short the bonds, you can short the equity, you can position yourself with options to get short. But at its simplest form, which I guess is what you're asking me for, you would just go and instead of buying shares, you would just sell short. And the difference really is in the risk. So when you buy a stock, if I buy $1,000 worth of stock tomorrow in a company, and the company appreciates in value 50%, I will make 50%. If the company goes down, it can only go down 100% to zero, and I will lose 100% of my investment. And if you go short a stock, it's just the opposite. Instead of your gains being infinite, your losses can theoretically become infinite, because as a stock continues to go higher and higher and higher, you can lose multiples of what you actually committed on the short sale. So really the risk profile of selling a stock short is far different than going long a stock. There's significant more risk. And again, your upside in selling a stock short is the exact same thing as your downside in going long a stock, which is 100%. So if I go out and I short, 1,000 shares of Apple tomorrow, and Apple goes to zero, that's the most I can make on that. I will make essentially everything that I got from the proceeds of the sale, and won't be able to make anything more than that because stocks don't trade in negative numbers. Right. Does that make any sense?
Total sense. So, okay, cool. so I'm glad we're talking here. You're making total sense here. Anyways,
that's good. That rarely happens, so I'd encourage you to continue to ask me questions, while it's happening here. Take advantage of it.
Okay. Well, then here we go. I got another doozy for you. So, now we're getting to the why. Why would you sell a stock short, and what are the catalysts you look for to then go and do that?
Oh, this is a great question. So there's a bunch of reasons why you would go and sell a stock short. Essentially, the way that I look at the market in general is very Darwinistic, right? If you think about the concept of free markets and you think about the price of anything, whether it's, a stock or a financial asset or a plum that you buy at the market, the price of the product is going to move higher or lower depending on certain variables. And in the fruit and vegetable market, for instance, when you go and you buy an orange for 99 cents at your grocer, when you come back a few months later, the price will likely have moved a little bit higher or a little bit lower. And that really all depends on variables, and I don't know much about fruit farming, but the point of the matter is I'm sure the amount of crop that comes in, the weather in certain areas, inflation, all these different variables that are involved will likely cause the price of the product to move higher or lower. And it's the same thing when you're dealing with an equity. You're dealing with the stock, right? Apple may be priced at $110 a share today, but in the next 6 months it will likely move higher or lower based on any number of infinite variables that come in, starting with near-term variables like the election, which will be taking place in a couple of days, to all different types of macroeconomic data, to data that is specific to the company, to data that is specific to the company's vendors, to sales data. There are a million different points of data that will come in. And your job as an investor or as somebody that analyzes investments is to try and take into account all of these, future variables and draw up a picture of what, perhaps a company's financial future will look like, essentially what they will return in earnings to shareholders over the course of a specified amount of time. And, essentially discount that of sorts, but also apply all of these variables and then come to a decision as to whether or not the current market price is too high or too low. And when the market price is too low, what you think you should do is go out and buy a bunch of whatever that asset is, because the market will hopefully, if it has any efficiency, drive the price of that asset up eventually. And if you go out and you say, look, the price of this asset is way overpriced, then that becomes an instance where you want to have tools available to you to go out and benefit from your analysis. Just because a stock's going to move lower doesn't mean that you should just sit on the sidelines and wait for it to get lower and then buy it again. You want to be able to capitalize on your analysis. And so a way to do that is to go out and then short shares of the stock. Hopefully you're right, the stock moves lower, and you cover your short for less than, the proceeds you gathered when you originally sold it short. But really, there's, that's kind of just the most basic example, right? Mm-hmm. Your analysis is telling you that that a price per share is not worth what will eventually be returned in earnings from the company. Mm-hmm. So that's a great reason. But there's many other reasons. Companies that are promoted, especially with microcaps. Microcaps will run really hard when they have, low floats and there's not enough sellers out there to go out and buy stock. So when there's, somebody can go out and buy a whole bunch of stock and drive the price way, way up to a point that is really irrationally exuberant. And you want to be able to sell short in those opportunities to capitalize off of what will be obviously a coming correction. There's just outright fraud. So, what's become more prevalent over the last 5-10 years is individual investors and research firms going out and trying to identify fraud at companies, selling the stock short, and then going out and producing the research to the public to kind of give the market some insight as to some of the risks that they see. There's an infinite number of reasons why an asset may be overvalued. And all short selling allows you to do is capitalize on what will be a move lower instead of the traditional way of investing, which is capitalizing on what will be a move higher.
Mm-hmm. So, and you kind of touched on this a little bit, but really, is there a difference between selling a microcap stock short versus a large mid-cap stock?
Yeah, there is, because there's differences in the way that microcaps move versus larger companies. So companies like Amazon and Apple and ExxonMobil and all of these massive, $100 billion corporations have to kind of abide by this law of large numbers, right? When a company reaches a $365 billion valuation like Facebook has right now, it's not likely that you're going to see a 50% upswing or 50% downswing in a week for the company because it is so monstrous. And the same, I guess Apple would be a better example because on an earnings basis, it's much, much cheaper. But Apple is an example of, the larger something gets, the less volatile it becomes. And that's why you see the market indices, which are really kind of the most diversified and the most liquid of any financial asset out there. You watch the Dow Jones average, and it moves 30 basis points in a day, and that's a huge day. God forbid it moves 3% or 5% in a day, and it's a headline, and it's all over the place, and people are usually either euphoric or panicking. And so the larger a company gets, the less volatile the trading is going to be. And when you're talking about microcap stocks, you're talking about companies that are very, very small. Nowadays a $50 million company is incredibly small. If you're not a $1 billion company now, you're not even a small cap. It's gotten to the point where, if you're a company that's worth 30, 50, even $100 million, you're still considered to be a very, very small company. And the smaller a company is, the more likely, and especially a lot of these microcaps have very small share structures, meaning the number of shares outstanding are going to be significantly less. Like Apple right now has several billion shares outstanding, right? So there's plenty of pieces of the Apple pizza pie to go around to investors. If I want to go out and buy 100 shares of Apple, it's very easy for me to do that at very close to whatever the price is now. When the share structure is much smaller, like it is in a lot of these microcap companies, are more difficult to buy, and especially to buy in size, and not move the price of the equity one way or another. And because there's this volatility, microcaps will often swing, 30, 40, 50% in a day or in a week. And you're much more susceptible to take a much larger loss in a microcap company when you are selling short, or when you're going long, than you are in a much, much larger company. I mean, I could go out and sell, 1,000 shares of Apple short today and say, if I absolutely had to, I'd be okay with, not looking at it for 6 months or 3 months. But if I went out and sold the same absolute dollar amount of stock short in a microcap with a very, very small share structure, it's kind of like a coiled spring almost, and a very, very small valuation, it's something that I would almost want to watch every tick of, because of how quickly things can develop, and how sometimes news in the microcap world kind of goes unnoticed. And a big problem is, if you're short a bunch of shares, I'm sure you've heard of the term short squeeze, I'm sure everybody has. What a short squeeze is when a bunch of people that have sold stock that they don't own all need to come back in and rebuy it at the same time. And what it does is it drives the price of the equity much higher, much quicker than just those investing and going long. And in a microcap, you are far more susceptible to a short squeeze scenario than you are in a much larger company, because there is so much less liquidity. Now, conversely, and just stop me if I'm prattling on here too much, but conversely, short selling can also have a very beneficial effect to the market. And I'll give you an example. Fitbit, for instance, was down, something like 35% yesterday on their earnings report, right? They came out and they released, and I don't have any position in Fitbit, but they came out, they released poor guidance, and the market basically drove the price of the stock down as they were adjusting to, what the future sum of the company's earnings will be now with this new outlook. And sometimes in a situation like that, you can make money shorting a stock, obviously, if you were short before the report. But short sellers will come in and kind of provide a little bit of a bid under the stock after it has crashed for a while. And so shorts can be beneficial in the sense that they help kind of stop euphoria to the upside when a stock runs, and they can also help kind of cushion a stock after it crashes when shorts come in to cover their positions. Does that make any sense?
Totally. And it's so funny you talked about short squeeze. I was literally just gonna ask for there's a couple terms that we hear out there, like short squeeze or naked short. I'll definitely ask for that definition for the naked short. But when it comes to a short squeeze, is when you're selling short, you're making a contract with the person you're borrowing from, and then that comes due? Is that why you then have to cover the short, or can you literally do it whenever?
It doesn't come due. It doesn't mature, kind of like what you're suggesting.
Right. Okay.
It's essentially, you're either, for one reason or another, you have to cover the stock. Okay. Either it's because the price of the stock is moving up and you are losing money on the trade, or because, maybe the price of the stock has moved up so much that your broker has decided, it's time to buy you in. It's time to cover for you because, you're in a margin call, and hopefully that's not what has happened. Or also sometimes brokerage houses are forced to go and locate stock that they have issued to borrow for one reason or another, whether it's, somebody trying to tender for the stock, or it's, the borrow has become very tight and they need to go ahead and provide the stock back to its original owner. And so there's a couple reasons that you can get squeezed. You can be bought in, your brokerage house essentially has the right to tell you it's time to close out this trade, and they will buy you in. They'll give you a notice, which is very cordial of them, but you're going to be out of your position when you open your account up in the morning. And a short squeeze is just, same as when you go long a company. When you buy a company and you get terrible news and the stock goes down 30%, and then it goes down 35%, and then it's down 40%, and then it's down 45%. The pressure kind of builds for you. Hopefully you can keep your emotions in check as an investor, and hopefully if your thesis remains intact, you stay calm. But there is that's a scenario where you think to yourself, well, maybe I should just be getting out here. Maybe I can either buy it lower, or I can take more time to kind of identify the thesis and see if it's something that, is worth selling for. And it's the same thing on the short side. You go out and you sell a bunch of stock short, and the stock all of a sudden starts to run for one reason or another. You may want to go in and say, I got to take this off the table because there's too much risk here. Or like I said, or if you get a margin call or something like that, your brokerage is going to go in and cover the stock for you. And so, those are kind of two elements that can make up a short squeeze.
So, and then what's a naked short? I've heard that phrase many times.
Yeah, well, naked shorting is a term that comes up often, generally with long shareholders in a company that are not doing well and looking for somebody to blame. But naked shorting is so when you short stock, there's certain rules, and I can't give you the exact definitions off the top of my head. But when you short stock, there's certain rules for the brokerages and market makers that are going to lend you the shares. And what they need to be able to do is they need to be able to say, here are the shares that we are lending out. So if I have two friends and you're one of them, and the other one is Robert Kraft, the owner of the New England Patriots, and Robert Kraft of Stock News Now wants to short 1,000 shares of Apple, and other Robert Kraft, I just decided to use the same name to make this more confusing, okay? the other Robert Kraft owns 1,000 shares long. What I can do is take them from him, even though, it's still going to show him that he owns those shares. I can essentially take those shares and give them to you for you to go out and sell short. And again, you will pay the other Robert Kraft a short amount of interest on those shares. And then, hopefully you'll cover and those shares will be returned to him. Naked shorting is when a market maker or a brokerage house or an investment bank goes out and shorts the shares for you, or will fill your short order without being able to locate the shares that it's essentially creating stock out of thin air almost. And it's something that a lot of different investment banks have been penalized for in the past. It is to the best of my understanding, for the most part, illegal. I don't know the actual law behind it. I just know that, brokerage houses and market makers need to be able to identify where a stock is coming from when they lend it to you. And a lot of times, like in the case of, what happened with, I think it was Porsche back in the day, right? That tremendous short squeeze. Brokerage houses and market makers had gone out and allowed people to short more stock than there was available. So when the chickens came home to roost and everybody wanted to cover or buy, you get this tremendous, move to the upside in shares. And so, naked shorting gets pushed around by a lot of people who watch long investments go under. I used to think naked shorting was this giant conspiracy, like many people do. And then I kind of learned how things work. So I would encourage you that if you're one of these people that has, lost some money in the market and are blaming naked shorting, to take some time and do some actual research on it, because don't think it is nearly as prevalent or as pressing of a problem as a lot of people make it out to be. But essentially it's a market maker or a bank giving you the ability to short a stock without being able to identify where they're borrowing it from.
Right. So Chris, I've done quite a few of these interviews now, and most of the guys that I've interviewed, they've all given me their investing strategy when it comes to all their different things they look for when they're looking to go and buy a microcap stock. So what do you look for when you're thinking about shorting a microcap stock?
Well, really, the best case scenario, what you want to find when you go out and short a stock, or where you're looking to identify a great short candidate, I guess the holy grail for shorts would be to find some type of provable fraud that you can go out and prove that nobody has noticed. And so it doesn't come around that often, but short sellers have this fantastic function in the market where they are essentially a nice counterbalance to people that go out and kind of tout a certain stock because they own it and they want it to go higher. Shorts provide, shorts are going in and looking for the opposite, right? They're trying to find out where the related party transactions are that aren't being disclosed, or they're trying to figure out why, in the case of, a company like Energus, WATT, which I have no position in, but in a case like that company, why it has a $360 million market cap and doesn't seem to have a product that will be going anywhere anytime soon, and certainly doesn't have any future earnings or future cash flows that people can go out and kind of forecast. So you're either looking for outright fraud or some type of fraud that you can kind of make the market aware of that they are not already aware of, or you're looking for a company that is just simply, for one reason or another, overvalued. And in the microcap world, companies, like I said before, because microcaps are so volatile, and because the over-the-counter markets where a lot of these companies reside are really, they're SROs, right? They're self-regulating organizations. And for the most part, they're cesspools. Companies are allowed to go out and take out promotional advertisements for their stock. These are like all these stupid emails you get on a daily basis, from all these companies telling you they have the next great stock idea, and it's something that's going to come out and cure Alzheimer's, or it's going to be the world's first solar panel for your iPad. Like, there's no shortage of ridiculous stories. But what happens in a lot of those scenarios is the price of those equities winds up getting pushed to levels that are ridiculous. And you're talking about companies that have, a lot of the time, no real product, no real prospects, a history of diluting their shareholders by issuing stock. And those are really the situations you're looking for. Mark Cohodes would say, and Mark Cohodes is another kind of legendary short seller on the street, but he would tell you to go out and play the man, too, to try and instead of, it's like in poker, instead of playing your hand, play the man. He goes out and he looks for management that has a history of, unscrupulous behavior. And then he try and find short candidates accordingly there. So that there's no shortage of things that you can kind of dig into to look for reasons to go out and short a microcap stock.
So I guess how about in the context of like information arbitrage, just even getting a little more detailed, like what with Maj said when he's going in and looking at the filings versus the press releases, what do you look for in there that might signal to you, okay, this might be an opportunity to maybe short this?
Well, you can look at the obvious things, right? So we'll take a very obvious example, right? Mm-hmm. There are several stocks that we follow that have a history of filing their 10Q with the SEC before they put out a press release to the public that explains their quarterly results. And so what you're dealing with here is you're dealing with two different audiences. You're dealing with a group of individuals that are savvy enough to read through SEC filings quickly. They know where to look for the financials. They know where to look for liquidity and resources. They know where to look for contingent liabilities, all the important things, the management discussion and analysis. That's one crowd. The second crowd is people that rely on press releases, which are going to be less absolute facts and a little bit more of management narrative. And so in an instance where you go in and a company files their 10Q 10 minutes before they put out a press release or an hour before they put out a press release, a lot of times what we do is we'll go in, we'll take a quick look at the numbers, we'll look to see if there's any adjustments to the numbers that need to be made or any one-time aberrations in the numbers, and we will try and make an investment decision based on those numbers and based on the management discussion and analysis and the other things that I talked about before the public gets the press release and really kind of tries to start to digest everything and Moss. And so really, you get an opportunity to the short side in the same way that you would get an opportunity to the long side. If you're running a company, Stock News Now comes out, files their 10Q tomorrow, and I can see in that filing that your net income is significantly higher than most people had estimated, and it's up 50% year over year, and your revenue is fantastic. And nobody else has really seen this. It's a great opportunity to go in and buy some stock before the story kind of gets out there. Conversely, if I open up your 10Q filing tomorrow, and I see that under assets, all you have listed is a pack of a couple slices of American cheese and a package of wheat bread, and you didn't earn anything over the last quarter because you spent a lot of money on stock-based compensation, which is a bad example because it's a non-cash expense, but you went out and you paid the executives a lot. Then I can go in and I can short that stock. And based on the commentary in there, I can do the same. Can go either long or short. So in a case like MGT, which we just wrote about a couple months ago, and I don't know if you just saw, was recently delisted from the New York Stock Exchange. One of the things we did was we went through the company's proposed acquisition of another company and saw in their filings that they don't really, make that joke about the company really only owns a couple slices of bread and some Swiss cheese, and that's really all this company owned. And MGT was going to go out and issue $150 or $120 million worth of stock to acquire essentially the shell company that really only had, I think, less than $10,000 in assets. So it's just finding these things and knowing where to look and getting to them, when they're made public, but before everybody else sees them. Mm-hmm. And that's really kind of what information arbitrage is. And again, they'll present as many opportunities to the short side as they will present to the long side.
Mm-hmm. And then, you've gone through a little bit here and there about the advantages and the disadvantages of selling a microcap stock short. But, just to kind of condense it into like a shorter answer, what would you say are like the 5 advantages and 5 disadvantages on both sides?
Well, the disadvantages to shorting a microcap stock can be that, again, really the main disadvantage is they're a lot more volatile than larger stocks. So it's something you're going to have to keep an eye on. If it is a company that is widely shorted, right, if it's kind of well known that the company may be a fraud, or if there's questions about the business practice, the interest that it is going to cost you to what they call the cost to borrow the shares, is sometimes so high that it becomes prohibitive to even what you are trying to make on the potential short sale. So that's another reason why sometimes it's tough to get into a crowded short. Oftentimes, too, microcap shorts will get crowded a lot quicker than larger cap shorts. And when that happens, sometimes stocks will kind of find a floor and not be able to go down any further, despite the facts being in your favor, but the mechanics of the actual market and who owns the share and who needs to cover and who's buying and who's selling won't actually allow the equity to move lower because you have so many people that have piled in short. Mm-hmm. So those would really be the big disadvantages, I would say. The advantage, and I think the biggest opportunity in shorting microcaps is if you look at the over-the-counter markets, okay, it is essentially a pool of, for the most part, sludge. I mean, there are a lot, there's a lot of legitimate companies that we've come across that maybe they just don't want to pay for somebody internally to have to keep up with filing requirements, or maybe it's a listing of a company really that trades primarily on another exchange, and they're kind of legitimate. But there are also an enormous amount of just outright fraudulent companies. Or if they're not outright fraudulent, they're companies that do not make money, do not earn anything, do not generate cash, and survive solely off of issuing stock, going out and selling stock, and things like private placements at a discount in order to fund operations. Mm-hmm. And so, the advantage of being able to sell short microcaps is really, when you're looking for garbage, which is really what you're looking for when you're going out and trying to short a stock, most of the garbage is on the over-the-counter markets. And, I'm sure a fair amount of that garbage qualifies as microcaps. So, but also, again, it doesn't have to be total garbage for you to go out and short. You can go out and short based on fundamentals, the same way you can go long based on fundamentals. But really what you're looking for is like I said earlier, management teams with bad backgrounds, companies with a history of diluting shareholders, companies that don't generate any cash. And those are kind of, hopefully terminal shorts that you can kind of go out and short the stock and not have to cover until it's at 0001.
So Chris, then, what short selling experience taught you the most, or what was the most memorable?
That's a good question. I mean, there's been numerous occasions where I've just gotten my head completely stomped in. And so those would probably make for some good examples. Really, what short selling has taught me is that there's a big difference between what the facts are and what the psychology of the market is willing to accept at the time. And I'll give you a couple examples. A couple of companies that I shorted and got my head stomped in on because I was right on the thesis, I was right on the fundamentals, I was right on whatever my investment thesis was, but I was wrong on how the market was going to view it, how the market was going to accept it. So first instance is Green Mountain Coffee, right, which is probably the worst short I've ever gotten killed on, although there's been a few. So Green Mountain was a company I went and shorted just maybe a couple months prior to it getting bought out. The company had a terrible balance sheet and sales were doing terribly. The K-Cup fad was starting to wear off. They had just come out with this horrendous, awful new product called the Keurig Cold, which was essentially, what SodaStream almost had put out before they collapsed and went much lower. But really, they were looking for a gimmick. They were looking for something to try and spur some organic growth. So they came out with the Keurig Cold. And it was a machine that was, the size of a Honda, okay, that you would have to put on the counter in your kitchen. It weighed about 4 metric tons. You had to start it up like a kerosene engine. It was loud. It was stupid. It did not make any sense in terms of cost efficiency. It was costing you $1.50 to produce 8 ounces of a beverage where you could just go out and buy a can of the beverage for 39 cents. It may be the worst product ever conceived, right? It was just downright horrible. And, of course, as it was failing, it launched and it instantly got horrendous reviews. And so I just spent a lot of time posting those reviews on my Twitter and letting the world know how smart I was and how terrible this product was. And then all of a sudden a German private equity firm comes in and takes the company private for 90% higher than the market price. And, 2 months later after that happens, of course, they come out and discontinue the product. So what does that mean? Well, here's what I learned. I learned that I was right about the product. I learned that Green Mountain Coffee was a terrible company with a terrible balance sheet and a terrible new product. But I also learned that people will buy anything. And that's really the lesson from that. I don't know what this private equity company is doing with this pile of garbage that they acquired at a 90% premium to market. I couldn't tell you. I've tried to conceive of every plan possible that they could be, maybe we'll load it up with more debt, we take it public again. There's a whole bunch of things in the private equity playbook that they might be thinking of. But I can't fathom one. So what I learned was, people will buy anything. People will take anything public, will take anything private, rather. And really, investors, both the biggest private equity firms in the world and the smallest retail investor, they will go out and they will buy anything. And so I really got my head kicked in on that one. And again, that was bought out at a 90% premium to market. So I got absolutely smashed on my short position. It was my largest short position at the time. And like I said, 2 months later, they discontinued the product. I'm sure everything is going horribly for JAB, who's the company that bought them out. But that's besides the point, because when it left the public markets, it left at $90 a share. And I shorted it at, $60 a share or whatever it was. Doesn't matter what happens to it now. It doesn't matter if the company goes bankrupt, So that's a good example. Another perfect example is, was QuestCore, which was, really the first company that got into this egregious price gouging, scenario that everybody is talking about now. So QuestCore went out and acquired a drug. They were like a $2 million company. They went out, they acquired a drug for $100,000, the rights to this drug, which has very limited clinical trials. And there's a million reasons not to like this drug, but I'm not going to get into it because I can talk about this company for hours. So I'll just keep it short. The point is they bought this drug for, I think, $100,000. They raised the price on it 70,000%, like 70,000% over the course of, I think, 8 or 9 years. They turned this company from a, $5 million or $10 million company to, I think it was like a $5 or $6 billion company when it got bought out. All the while abusing the insurance companies, ignoring the fact that there was no clinical data out for this drug versus the much cheaper synthetic, ignoring, essentially this drug had been grandfathered in by the FDA in the 50s, okay? It's been around since the Model T Ford, and nobody was using it. They were able to buy it for $100,000 because everybody knew that its competitor, which was essentially certain steroids and a synthetic version of the drug, worked just as well. But what this company did was they bought it and they created a narrative. They started to pay doctors to talk about it. Wow, it's doing great things for my patients. We don't have any double-blind, placebo-controlled clinical data for it, but we have a doctor here that will tell you that one of his patients told him that it was like, quote, liquid gold, right? So this company becomes a $6 billion enterprise based on this, essentially like non-existent mirage of a drug. I mean, it's really the best way to describe it. With almost zero clinical data. As a matter of fact, they did a lupus study after it went private that failed miserably. Like the first time they said, let's go out, we'll get some data, horrible data. But it doesn't matter because Mallinckrodt, which is another pile of garbage that is significantly over-levered, and there are, a million questions about Mallinckrodt that can be talked about, came out and they bought QuestCore at, a premium to market. I think maybe 30 or 40% premium at the time it was bought out. And I was beside myself that nobody, the FDA, the mainstream media, there were a couple articles. There was a great article by Gretchen Morgensen on the company in the New York Times. There was a guy named Orenstein that published a beautiful article in ProPublica about the company, asking the right questions, but the market just didn't care. The market was looking at the earnings. The market was looking at the amount of money this drug was able to produce. Doesn't matter how they were getting it out there. And that's all Mallinckrodt looked at. Hey, this will be accretive to earnings. And, we don't really know what it is or where we get it from or exactly how it works, which is essentially what the company has said. But we're going to buy it for, $10 billion or whatever it was. And I got smoked on that trade, too. I've had a little bit of, good news in the fact that the narrative here around Mallinckrodt is kind of starting to come out. But that was another instance where, the thesis was correct, right? Acthar gel, there's no proof that Acthar gel, which is the drug, is any better than, common steroids or the synthetic equivalent. But that doesn't matter because I got smoked on the trade because Mark Trudeau, the CEO of Mallinckrodt, decided it would be a good idea to buy this company. And to this day, when he is challenged about the drug, the chemical makeup of the drug, the basically the different indications that they're offering the drug for, insurance companies that are now starting to raise questions about the drug. He has not made comments with any specificity that addresses the concerns around the drug. He says, we're trying to build value for our shareholders. Everybody have a nice day. And that's it. So it's another great example. And then, of course, probably the most prominent example here over the last 3 years has been Herbalife, right? Herbalife, very clearly a pyramid scheme. Everybody knows it's a pyramid scheme. The Federal Trade Commission knows it's a pyramid scheme. You know it's a pyramid scheme. I know it's a pyramid scheme. And what's happened? The stock's traded sideways essentially for 3 years. So all your cost of borrow, winds up costing you a significant sum of money. And all of the time value that's built into the options, if you went short using options, winds up going against you too. So I think that's a great scenario of right thesis and wrong timing, or poor ability to judge the market's perception.
I was just going to say, that seems to be the moral of the story somewhat in your experience, is that it's sometimes difficult to judge how the market's going to receive a certain bit of news or look at a company. You might have your thesis, you're ready to go, you think you made the right choice, and yet here they come in buying the company at a premium to market. Like, how the hell were you supposed to know they were going to come in and do that?
Well, right, and what's crazy is in a case like Green Mountain Coffee, I mean, the product was so clearly a disaster that, you say to yourself, why the hell would anybody come in and buy this? Unless what I think probably happened in that case, judging by the price it was taken out at and the timing, was probably that they had started talks to take the company private much, much earlier, before this product had actually, launched full scale. And perhaps they didn't know what they were getting into, or perhaps they didn't know how it was going to be received. I was just talking about this in Vegas a couple weeks ago, where I spoke at a conference, and one of the points that I made was, you need to have the thesis right, but you also need to have the timing and the psychology of the market correct as well. And that's just as important, because if you have proof that, a major, massive Fortune 500 company is a fraud, like Harry Markopolos did with Enron, and you go out and you're screaming from rooftops that Enron is a fraud, but the market doesn't want to listen to you, you're going to get your head stomped in on a short position. And, Markopolos is a perfect example, right? He came out and was telling the SEC for years prior to Enron collapsing that it was a fraud, right? And really, Markopolos, not very different from a short seller. Why? He was looking at the company because he was looking at Markopolos was Madoff, rather. But Markopolos was looking at Madoff because Madoff was a competitor, right? And so he identified that Madoff's returns were unlikely using, split strike conversions or whatever he said he was using. And he had a vested interest in pointing it out, certainly, because I think, again, Madoff was a competitor. But Sharon, I'm trying to think of the Enron whistleblower, but there was an Enron whistleblower as well, and that's why I'm mixing the two up. But the point is, they both had whistleblowers, and nobody wanted to listen, right? Until Madoff blew up. The SEC didn't even come in to the Madoff situation until he had already blown up. It was like 2 days after the media, ran the story that Madoff was a fraud. And the SEC came in, they're like, we're going to open an investigation now. This is serious stuff. I can't imagine being Harry Markopolos. And if you go back and you look at his congressional testimony that he put forth after Madoff collapsed, I mean, you can tell the guy is just pissed off. And he's pissed off not only because regulators didn't catch it, but because nobody wanted to listen to him when he was shoveling information onto their desks. And so that's very similar to a lot of short theses that, I've seen, where I feel like I have the thesis right, or I'm reading somebody else that feels like they have the thesis right, but the market really doesn't care. They're not ready to accept it. So two kind of separate items.
So then, what is your advice then for new microcap investors about short selling microcap stocks?
My advice would be to be very, very careful. And, my advice would be the same advice that I would offer anybody who is investing long or short in any company of any size, which is familiarize yourself as much as humanly possible with the other side of the story. You cannot go in and short a stock. I cannot go in and short a stock, and I can't go in and go long a stock unless I feel like I have a fundamental and extraordinarily clear picture of what the case against me is. So there have been many occasions where, and actually one just recently, there's a stock that I'm long, and there is a large hedge fund manager who is short, one of the biggest guys on Wall Street, and I called his office up. And I said, let me talk to this guy. And I got him on the phone, and I said, look, I need you to tell me why I'm wrong, here, here, and here. And I listened to the whole case, essentially probably the best case that the street had out there, right? This guy's a huge advocate for his position on this company. And I said, okay, that's what I thought. That's what I had already kind of baked into the cake in my analysis. And conversely, I have done the same, and I find it a little bit more fun when I'm short a company and I feel like I've found something that the mainstream hasn't caught on to yet. I like to go out and pester the people that are long the company and say, look, here's what I found. Can you refute it? Do you have an answer for it? A lot of times, too, it's fun to ask the company. Mark Trudeau of Mallinckrodt, do you have a firm understanding of what the chemical composition of this drug is? Can you hand me clinical data tomorrow that says that this drug has better efficacy than a synthetic or a placebo in any of these indications that you're selling it for? And he won't answer that question. And the reason is because he doesn't have the data. So when you get to an end point like that, you get to kind of a place where there's no rebuttal or no retort. That's kind of where you've got maybe a little bit of fact that you can hold on to. So my advice would be reach out to management in either scenario. When you're short, sometimes you have to finesse management a little bit. Hi, my name's Chris. I'm interested in the company, and by the way, I have a question about this, undisclosed fraud charge from 1992. You kind of have to finesse your way into the line of questioning. But the point is, make a little bit of a pest out of yourself. Be cordial. Be polite. Don't be judgmental. Be willing to talk about anything. Go into it with an open mind. And what you're trying to do is just get a clear assessment of what all the absolute facts are, things that cannot be refuted, cannot be argued. And once you get those out, you kind of get somewhat of an objective picture of the company, and from there you can kind of, say, look, if this goes against me, I have the thesis right, so I can just keep piling in, or maybe it's time for me to reconsider. And so that would really be my method of attack with microcap shorts, but also with microcap longs and with any type of short or long investment. I just think investors kind of owe it to themselves to do that degree of diligence.
And then what do you think are some good resources for new microcap investors that they can use to learn about short selling microcap stocks?
Oh, that's a really good question. I think going out, I think more important than learning about short selling is to go out and get a fundamental understanding of how the capital markets work in general. So you have to have a grasp on equity valuation. You have to have a grasp on, kind of the process of the equity markets, how the supply and demand part of it works, how kind of, the number of shares a company has outstanding ties into its valuation, and how that makes a stock price and what that stock price means compared to what a company is earning or is not earning. You really have to have a firm picture on all of those things. Now, the nice thing is that the SEC requires most companies that file, to kind of play by the same set of rules. So I know if you hand me a 10K from a major corporation that I've never seen before, that there'll be a section in that 10K that's, something like capital and liquidity resources, or, management discussion of our financial results. Those are things that every company is going to have. So kind of once you learn the format and you learn exactly what every company is going to be providing, it then gets a lot easier to get a clearer picture of those things as compared to maybe their peers or competitors. But also it becomes a lot easier to find this stuff and make it a little bit more accessible for yourself. Again, with microcaps, you have the advantage of generally management is a little bit more available. So there's nothing wrong with calling management and speaking to them. Obviously you don't want any material non-public information, and most management is good about not disclosing that, and they won't do that. But you make that clear. But you're certainly entitled to as much explanation of items that have been made public as you would like, or that management will offer. So that's really kind of where there's an advantage to microcap companies, where there isn't, you and I couldn't go out tomorrow and call up Tim Cook, say, Tim, let's talk about the iPhone trends in China. What are you thinking? Right? I mean, we wouldn't even make it past the secretary. But, if there's some $50 million company that I want to get in touch with, much more likely of a chance that the CEO's cell phone number is going to be at the bottom of the press release as opposed to, the IR office, right?
Mm-hmm. So, Chris, again, I want to thank you so much for coming on. And where can my audience go and find more information about you and some of your writings?
Well, you can follow me on Twitter. My Twitter handle is @QTRResearch. And so you can follow GeoInvesting on Twitter also. We're @GeoInvesting, GeoInvesting. And really, we're fairly active on there. So whatever it is that we're involved in at the time will be on there. GeoInvesting's website is GeoInvesting.com, same spelling. And so there's a fair amount of resources on there as well. But I'm very, very accessible. You can pick up the phone or call me or email me anytime, and be more than happy to really talk to anybody about anything.
Well, Chris, again, thank you so much for coming on the podcast. I learned a heck of a lot today, I got to say. Thank you.
Thank you, Bob. I'm hoping your Patriots can take it all the way this year.
Dude, I thought you were an Eagles fan. What are you talking about?
All right, buddy. Thanks so much.
All right, thank you. Take care. Thank you all for tuning in to the Planet MicroCap Podcast, and thank you, Chris, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@stocknewsnow.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of stocknewsnow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.